just... hello everyone. Look, thank you for choosing my session. For those who have logged in, yes, you get the chance to listen to the exciting topic of banking and finance for the next hour or so. I absolutely love it. Those of you that don't know much about it, or perhaps not as familiar, banking and finance, hopefully you'll be better educated at the end of this session. So we've got a bit to cover off on. So let's get into it. Getting the slides. So look, we're really talking today at a high level about different types of funding, how the debt equity piece works, and really how to maximise, as Amanda said earlier in the introduction, getting your broker or your bank to say yes for an application. So bit of background on myself. I heard a bit of the introduction that Amanda gave. So in case any of you were wondering who got the top ruck job, Alistair will probably say he did, but I like to think I did. But anyway, moving on. Look, I worked at a major bank. Actually, before that, I worked in accounting, then worked in a major bank for a number of years. And when I was at the bank, I saw an opportunity really to leave and start up my own business. At the time, in 2007, I had one client. And went from there. So 13 years later, that's Capital United. We've got a small team of banking and finance experts, and really we love passionately looking after our clients' interests and represent them in negotiating funding structures and optimal funding terms. And then in 2013, in the banking and finance sector, I started up a business called Keystone Capital with my business partner Lachlan Perks, who's based in Sydney. So we've got an office in Sydney, office in Adelaide, and we're basically private lending and asset lending effectively, which the banks really pulled back from post the global financial crisis, which we'll talk about in a minute. So yeah, got a bit of experience and background in the finance sector. So I guess just at a high level, and those that want to jump in and ask questions and have a chat, I'll try and see those on the left-hand side of the screen here and answer those as they pop up. But perhaps we'll just try and get through the bulk of the presentation. We've got a bit to get through, and then maybe leave some question time at the end. So the two types of funding that we're going to talk about today are land acquisition funding and construction funding. And if you're really clever, it's perhaps combining both of them so they can happen simultaneously. But the two main components are land and construction. So really, when we're looking at land funding, that's generally the typically the longest debt hold. So when you're looking at you're funding a residential block of land effectively, that may be a bit of technical. We're all good. I was on mute the whole time. Excuse me, guys. So what's happened here, guys? The presentation.
Yeah, so the presentation's live now.
Oh, we're live now. Okay. So I'll just quickly go back. Oh no, we're fine. We'll keep moving on. So look, thanks guys. Thanks Alex. Thanks Amanda. So look, the land funding component is often the most important aspect when you're initially starting out. So typically the banks will go to a loan to value ratio of up to 80%. Now you've got to also factor in stamp duty and on costs. So as a rule of thumb, it's different in every state. Some states are actually giving stamp duty exemption for residential property purchases. So it's important to understand whether you get that information off the conveyancer, the bank, your broker, to understand if you might have exemptions for stamp duty. And here in South Australia, we don't actually have any stamp duty exemption, but generally allow up to 5 to 6% of the purchase cost when you're purchasing. So really upfront, you'd need, as a rule of thumb, about 20% plus on costs to fund the acquisition of the land. And then moving into construction funding. So if you settle on the land first, you get your development approval, you do your feasibility, you satisfy or you qualify for construction funding with a bank or a lender. Typically they'll go to 60 to 70% gearing on the as if complete value of the property. So on that scenario, you're looking at getting a valuation on the complete product, take off GST, and then you've got to allow 30 to 40% cash equity in up front. Now, the equity up front can be either cash or extra land equity as security. So when you're talking about, for example, a completed asset of say 1.5 million, using round numbers, 3 properties worth 500,000, ex-GST. So let's say the selling price of 550,000. So you've got an ex-GST value of 1.5 million. Generally, you're going to need about 500,000 in property equity or cash equity to contribute to the transaction. And then if you're really clever, you can actually get a delayed land settlement, say a 6-month time period to allow you to get your feasibility up and running, get your development approval, get everything in place, your fixed price contract with the builder. You might need a quantity surveyor involved to verify the costs, but basically the checklist, which we'll go through in the future forward slides, if you're really clever, you can actually settle on the land and start construction simultaneously. So I know we've done a few funding projects like that with Amanda, and that works really well. So if you can try and coordinate that, often that's not the case, but if you can try and coordinate a simultaneous land and construction arrangement, good on you. So in terms of lending options, there's a few. I'm just talking about the debt space, obviously. I think Andrew is coming on later to talk about potential equity plays, but I'm just talking about debt today. So we've got major banks, obviously, are very important, and it's important to understand the banking sector in Australia when we're looking at bank funding. So we've got you'll hear the term APRA, which is Australian Prudential Regulatory Authority, regulated banks. So they're the banks that can take deposits. So any Australian deposit taking institute is governed by APRA, where the non-bank lenders, the private lenders, are governed by ASIC. So there's 54 banks operating in Australia, 14 predominantly owned, Australian owned, and 40 foreign owned. All Australian banks are ASX listed, and I guess the other important thing to understand is of banking asset value, 80% in Australia sits with the big 4 banks, which is extraordinary when you look at Australia compared to some of the global banking jurisdictions. A good benchmark is about 50%. So we're very heavily weighted with the big 4. There's an emerging second tier market, and when I say second tier, I'm talking about lenders, credit unions, and smaller, I guess, lending institutions. Some of them are jointly owned by the big 4, but we'll go through that in a minute. And then there's private lending. There's a growing number of private lenders entering the space, and that's pretty much driven from, I guess, post-GFC regulatory macro reforms that have come into the market. So the banks sort of really pulled away from asset lending around the GFC, because that, I guess, caused the collapse of some US and European banks, which the banks got together internationally and set up, it's called the Basel Accords, which is in Switzerland. The banks meet there once a year, and they set the international recommendations for global banking, and then it's up to each country to adopt those recommendations. So look, around the height of the GFC, and look, we're going back to the GFC to understand the current climate. We've got to sort of talk about the GFC. So the Australian government, in their wisdom, or perhaps not so, allowed the merger of a few second tier banks. So basically what happened is around the GFC, the big 4 banks acquired some of the second tier banks. So CBA bought Bankwest for 2.9 billion in 2008 at the height of the GFC, because the government effectively didn't want collapse of the banking system here, which in hindsight was never going to happen. Westpac acquired St George, Bank of Say and Bank of Melbourne, and Adelaide Bendigo Bank moved. So I'll just make that point because it's important to understand, who the players are. So when you look at Westpac and you're dealing with a St George in Sydney, Melbourne, Queensland, and here the equivalent's Bank SA, you've got to understand that the policy effectively has been driven by Westpac, even though they're separate brands. And then Adelaide Bendigo Bank merged. So just quickly, when I talk about the size of the banking system and the big 4 holding 80% of the assets of the total banking system, you've got to understand the market value of CBA, for example, as of today is around 150 billion. NAB and the other big four, the other three, are in that sort of 100 to 150 billion. But then you go right down to get Adelaide Bendigo Bank at 4.5 billion. So the size is quite extraordinary in terms of the big four. So look, getting into who the players are, we've got a good sample of lenders on this slide. That's not everyone, but just a quick snapshot of who's doing what. So really that box there on the left-hand corner on the slide is the big four on the wholly owned subsidiaries. I put Macquarie in there as well, who are doing quite a bit of lending. And then you've got some fringe players, and we've dealt with some credit unions who can be a good source of debt funding. La Trobe's a sort of non-bank. They're governed by ASIC. They're based out of Melbourne, but they do a bit in the construction and development space. You've got Australian Unity. They're mainly on the residential side, but you've got a good sort of mix of, I guess, first tier and second bank tier on this slide. So I assume these slides are for you to keep and share. So refer to that list when you're looking for your funding. So I thought the next slide was important to put up. So it's this slide here is looking at the asset values in Australia. Now the source is CoreLogic, who are very good at gathering national data. So it really just shows the value of the residential real estate market in Australia is huge when you look at the other sectors. So 7.5 trillion sits with the residential real estate asset value. You've then got to go down to 2.7 trillion, and this was taken in January 2020. So it's be interesting to see where it all sits now, but it'd be roughly around these sort of numbers. So the Australian superannuation funds hold 2.7 trillion in asset, 1.8 trillion in ASX listed companies, and then 1 trillion effectively in commercial property. So residential property by far and away is the biggest asset class in Australia, and obviously the most funded asset, I guess, in the Australian banking sector. So look, that's a bit of the macro talk. So now let's get into some of the micro stuff. So, what do the banks look for? It's very important that you go in prepared. You've got realistic expectations, the timing, the information you need to present. So really the next few slides will talk about your overall financial position and how important that is. The fact you've got to demonstrate serviceability, which is the key criteria for the banks at the moment. Feasibility of the transaction is very important. And I know Amanda's talking to you a lot about that today. And your credit rating. I can't emphasize enough how important your credit rating is. So before you actually go and get funding, you've really got to understand through your broker or an advisor, get a credit rating score and perhaps see if you can improve some areas. There's some good financial organisations that can help improve your credit score. But whatever you do, don't miss a credit card payment or fall behind, because that credit footprint is with you, and some banks won't actually lend to you, even if you've got an accidental or a small default on your rating. So very important you get that done. Perhaps when you're approaching lenders, I'd suggest maybe asking them not to leave the footprint of their inquiry until they're at the formal approval stage, because you don't want to clog up your credit score with a whole lot of lenders having inquired on your credit rating. So they're just a couple of little tips. So when the banks looking at construction and development funding in the residential sector, there are some key parameters they look at. So this list may be a bit daunting for those that haven't done this before, but for those that have, hopefully there's some familiar terms here. So I'll just spend a little bit of time on this slide and go through each point. So the main one is the loan to value ratio. So I think we all understand what that is. That's the loan against the value of the property. And when you're doing, I guess, the initial land or the construction piece, you've got to take out generally GST. So that can be, depending on the lender, 50 to 80% of the asset value. Another one which you may not be familiar with is the loan to cost ratio. So where you've got for example, a land settlement, and then you go into the construction piece to get an as-if complete value, there could be a significant uplift in the the DA approval, which will be reflected in the as-is value. So the banks have sort of slipped in this loan to cost ratio to make sure that there's enough equity from the developer or the owner, into the transaction. So if there's a significant uplift and then 100% debt funding and the LVR is still at 70%, they won't allow it. They'll take the lower of the LVR, which is the loan to value ratio, or the loan to cost ratio. So very happy to answer some questions around that if you need some further clarification in a few more minutes. Debt servicing is very important. So the banks, post Royal Commission, and in sort of probably the last 2 years, have introduced a measure called the debt to income ratio. So that's for the APRA banks, the big banks we talked about earlier. So they've basically introduced this measure to try and put a lid on the amount of borrowings individuals and groups can take. And generally that sits, depending on the lender, but 6 to 8 times your income. So if you're earning $100,000, they will limit potentially your borrowing capacity on the land settlement component from a serviceability point to 6 to 800,000. But look, it varies to lenders and non-bank lenders. So I'll just sort of mention that. Some credit union lenders don't have that requirement, but most APRA lenders do. Pre-sales is quite important. So some lenders will look at, if you're doing a 3 residential development, a 4 or a 6, obviously the more you have, the banks will probably want to see a level of pre-sales. So I think it's important, Amanda will probably attest that the completed product, you're going to get a higher price than selling off the plan. So if you can try and minimise your upfront requirement from a pre-sale point of view, you're probably going to maximise your end value. But from a conservative viewpoint, it's always good to underpin, I guess, the project with some pre-sale commitments. So it just depends on your risk appetite there. Sales contracts are quite important. So it is important to seek, legal advice, work with your conveyancer, your lawyers, maybe your accountants, but they've got to be pretty good on the sales contract side, but it's definitely a legal genre. So when we're talking about sales contracts, it's important the banks will look at sunset clauses. So what we mean by sunset clauses, if you get a purchaser to sign up to a pre-sale contract and you've got a 12-month build program, the lenders will want to see that the contract is in play 12 months post practical completion. So there's no point having a pre-sale contract and a 13 or 14 month term on that contract, because if there's slippage on the construction program or things don't go according to plan, the banks probably won't take that sort of tenure into account as a pre-sale. So it's important up front that when you're going into the pre-sale territory, you really do your homework and you get the appropriate legal advice there. Another important aspect the banks will look at is project profit. So they obviously want to see that the project's going to make a profit, and generally that needs to be above 15%. But look, we've done stuff, around the 10%, but beyond 15% on your feasibility is important. The lenders will want to make sure that your DA and your environmental approvals are all in place and they're nice and clean and clear. So you're probably going to have some conditions on your DA, but as long as you can explain those up front, how you're going to mitigate them, how you're going to deal with them, that's important. Personal guarantees in this space are an absolute must. It's only for sort of the bigger corporate projects that you could probably get away without personal guarantees. But look at in the 3s, 4s, 5s residential developments, you have to provide personal guarantees that cover 100% of the debt. So if you've got a joint venture group, we might be able to get away with limited or what's called several guarantees, where you limit your guarantee to the equitable portion that you have in the project. But generally, the banks will want 100% coverage on personal guarantees. The build is obviously very important up front. So the banks now in this environment are doing more and more DD on the actual building group. So it's all good and well to have a fixed price building contract. Fixed price and time is important, but you really need to provide the lender, your broker, or if you're going direct, your lender with enough information on the builder, you know, their CV, background projects, etc. So that's important. Understanding what the valuation will look like up front is important. Obviously, you're going to do that sort of homework, hopefully pre actually getting the land, because you know you're buying the land for a reason. So you'll obviously be doing a bit of feasibility pre-land acquisition, but understanding what values you're going to be playing with and what equity will be required to meet that loan to value ratio shortfall. A quantity surveyor, I put that on the slide here. Quantity surveyor can be important, particularly if you're doing over 4. A lot of lenders will require a quantity surveyor to be involved. Now, the quantity surveyor just allows the bank to, I guess, verify the costs that have been spent on the project. They don't have time to go and verify, you know, all of the costs, whereas a quantity surveyor will. They'll go out on site, speak with the builder, make sure that all the expenses that have been asked the lender to pay have been finished, and then the bank will release off the QS report. So that can be a requirement. And then the banks will also, in your feasibility, want to see a contingency. So generally, a builder might have their own internal contingency. If you're getting an independent builder, you've got some other outside costs, the banks will want to see a component of contingency, and that can be anywhere from 5 to 10% of the total project costs. So the list of information you now require, this is the next slide, for the banks. The last few years, it is pretty exhaustive. It really is a know and show environment, so don't second guess what the banks might need. Really, I encourage you, don't try and get clever and only sort of drip them information. You're going to get a really good hearing if you package it all up. You've got a concise bit of information. Get a list together, information pack. But the banks really want to know and understand everything you're doing in relation to finance. So it really is a know and show environment. So the more you can give them, the better, I guess, audience you'll receive. So some of the lists, and we'll whip through those because we've got a few more slides, but we'll open up to question time. So statement of assets and liabilities is very important. So you've got to cover off everything there: your superannuation, you know, your properties, any cash that you have. Said your superannuation fund, even personal effects, your debt. So a lot of lenders have their own templates. But work with your broker or get some templates online off the lenders you're looking to approach, and just pre-populate those to actually work on that. Monthly cash flow summary is very important. So the banks really look for the inflow and the outflow of cash, and some of them are actually going historically off your bank statements. So if you're looking to borrow in sort of 3 to 6 months' time, perhaps just be careful of what you're putting through your day-to-day account, because it will be scrutinised. And as long as you've got explanations for, you know, one-off items, etc., you've really got to go into that detail, because they've got clever software that can, you know, work out what you're spending historically. So it's just having all that ready. Privacy forms, 100-point ID, that's all standard stuff. You'll need up-to-date pay slips, tax returns for the last 2 years, a copy of transactional bank accounts. You will actually need credit cards. So credit cards are becoming a bit of an interesting one. The banks apply a 3% rate on credit cards fully drawn, even if you're clearing it every month. So look, to be honest, the less credit cards you can operate with, the better. You know, we've got a few borrowers that come through Capital United, and you know, they've just been a little bit lazy where they've accepted in the post, and the banks have been a bit sort of aggressive with their rollout of credit cards historically. And some of our clients have, you know, 5 or 6 credit cards that they might not even use. But the banks view that as a bit of a negative, and they'll get the limit, and then if you've got a limit on the credit card, they'll assume that it's fully drawn. So that will absolutely impact your servicing. So the less credit cards you can operate with, the better. It's another little tip. Bank lending application forms are all different. Obviously, if you go through a broker, you don't need to duplicate and save a bit of time there. The broker will handle all that. So then on the property side, you need most recent council rates notices, purchase contracts, obviously important, fixed price build contract with the builder. Don't worry if you haven't actually locked in a builder by the time you need to settle on the land, as long as you sort of understand what the cost might be. So before you settle on the land, work out roughly, that's what no doubt Amanda will be telling you, what the feasibility parameters will look like. Development approval is obviously important. Be realistic and understand the time frame, the council you're working with. No point working your feasibility up and it might take you 12 months for a development approval. But that's where you've got to allow, and the banks will allow enough time to actually get that development approval. And as long as you can service the land bank loan, that's fine. But allow yourself enough time there. Project feasibility, obviously the banks will want to see that. Agency agreements, that's important to maybe have a bit of a marketing plan up front, work out which agent or agents you're going with, copy of insurance policies and other information, so that the information requirements are quite extensive. So having that up front, the first project you do, for those that are embarking on their first project, just get all that together, and then future projects, it'll become a bit more seamless and you'll get into a bit of a rhythm and it'll be less daunting. So it's important you collate a list of information. So this next slide really breaks down the components of funding. So land purchase, so going back to the early slide, if you're settling on land before you've got development approval and you're getting into the construction piece, just put up a standard slide here. Purchase price 500,000, stamp duty non-cost, let's allow 30,000. That's roughly 6% of the total cost. You've got 530,000 as your funding need. So then if you're looking at an 80% debt package, we're talking about equity in, cash up front of 130,000, debt you get potentially 400,000, which matches obviously that 530. So that's the land component. And then the construction piece. So the banks go off an end value, so an as if complete value, where we're looking at, say, total project costs might be $1 million on this example. You've got the land purchase in there at 530,000. So your total project costs, let's call it 1.53 million. So at a 70% loan to value ratio, you're looking at equity required of that 70%, 459,000, and debt funding of 1,071,000. So again, with the equity component, you can either put in cash or additional property security towards the transaction. So that's that slide. And this slide here is a bit of a repetition, but how does construction funding working? So what we've got here is total construction costs or funding costs of 1.53. We've got a 60% loan to value ratio on completion value of the project dwellings ex GST, remember, of 2 million. So you've got a debt funding requirement of 1.2 million on this scenario, and equity funding upfront of 330,000. So this is sort of showing where there's been an uplift in the project site related land value. So if you're clever, you can obviously maximise, or you find the right property, you can maximise your debt, because debt is obviously going to be your cheapest form of funding. So it really depends on a scenario by scenario. No two deals are the same. You're going to be anywhere in the sort of 2.5% funding. I mean, funding is very cheap at the moment, right out to the private lending market at 10%. So really, the lower the perceived risk, the better your funding application, you're going to get obviously a better rate. So it is important to understand that. So really, at the end of the day, I'm probably going ahead of schedule here, so plenty of time for questions. The key messages that I really want to get across today for your banks to say yes. Understand what you're looking for from a funding point of view, and understand what the eligibility criteria is. So everyone's time poor. Bankers are time poor. Bankers, path of least resistance. If you can work with a banker or a broker, and you know what you're doing, you know what the eligibility criteria is, you'll get a quicker, a faster response. So summarise the key aspects of the funding need. So really, outline if you amount, put together a bit of a funding memo, like your feasibility, but put words around it, not just qualitative, but quantitative as well. So look at the loan amount, the term of the loan that you're looking for, the security that you're putting up. When we talk security, with some lenders will look at projects on a standalone basis, but you might get more flexibility if you put your existing assets into the pot, offer that as security, and maximise your security pool if you can. That can help. Depends on individual circumstances, obviously. Really, put in some information about the builder. Obviously, you're not going to enter a building contract with a builder unless you understand them. So you've got to articulate that to the lenders. What are the perceived risks? So banks actually like it when you actually identify what the risks are and that you know how to handle them. So, if you go into a project saying there's absolutely no risk, then you're probably being a little bit naive. So I think, go into a bit of detail there. It might be, development approval risk, and you obviously counter that with you've got a strategy how to get the development approval. It sits within current zoning. Environmental is not an issue. Project delivery risk is not an issue because you've identified a great builder and they've got capacity. All of those sort of things. What's the market? Why are you buying where you're buying? What team do you have behind you? So if you can convince the lender or advise the lender that you've got a good sort of advisory team behind you, you've got a conveyancer, accounting group, legal team. So go into detail there. And how importantly are you going to repay the loan? So banks are okay about the in and out type of debt, but if you sort of paint the picture that you're going to be a long-term borrower, lots of projects going forward, rather than just you gear up for $1 million, you pay it down, and then you'll never see them again. They're probably going to be less likely to give you aggressive terms. So you really got to have a good working relationship with the bank. Encourage them that you're going to be around for a while and do lots of business. So once you lock into a good lender, and it's important you have a few options because lending rules change. Go for it. Marketing strategy is also key, so it's important you articulate that. Repeating myself a bit here, but create a checklist of supporting information. Have the right expectations going in regard to timing. So don't don't go to the lender and say, just bought this bit of land and I want to settle in 30 days. Can you help me? So general are sort of 45 to 60 days. If you've got all your information up front, I'd say you could probably do it in 45 days. But if you don't have all of the information up front, perhaps allow 60 days. So have the right expectations there. And where you can, I think, use an expert, use a broker where you can, someone that understands the local area. Doesn't necessarily have to be someone locally, but someone that understands banking and finance in the construction and development space, because there are a few nuances. So the volume of, borrowers going to brokers has increased significantly over the last few years. So when I first started the business in 2007, the evidence suggested about 10% of all commercial loans were going through a broker or a debt advisor, whereas while the clock forward to today, that's more like 60%, and that number's growing. And on the residential, straight home loan market, back in 2007, that was 30-40%. That's now sort of 70%. So brokers give choice. They've got access to the market. Ultimately, it is a cost to the borrower, but the banks are happy to pay in some instance commissions. So work with a broker that's going to give you a choice, and then you can just get on with, I guess, what you guys do best, and identify projects, work with your team, and go from there. So now, look, that's the end, I think, of the presentation. It is. So I'm going to try and see. I've just lost Amanda, who was on my left there. I'm just going to see if we can get the questions going. Hang on. So Amanda, I just need your help here. Excuse me, guys. Don't actually know how many are in this session, but how can I see any questions? I finished the bulk of the presentation. You're not going to pop in and say hi, no? There you go. Right. So are they live questions?
Yeah.
Okay. So, right, we've got a few there. Thank you. So I'll just go down and pick a few here. So, okay, so I'll just start with Catherine. Catherine's question. So I don't know where you're from, Catherine, but hello. Catherine's question is: are companies such as Capital United state specific? So, look, there are a few national broking groups. We've got a bit of a presence ourselves in Sydney, but as I said earlier, you really just need to link in with a broker that has expertise in construction and finance. So they don't necessarily have to be in the same state, but sometimes it can help. So let's just keep going here. Sorry, this is a bit clunky, guys. From my point of view, that is. Okay, so sorry, is there any chance making the PowerPoint bigger? A bit late for that, sorry about that. Okay, how much pre-sales does your organisation require before the funding gets released? So really, if you're doing a 2 residential, you could probably get away with no pre-sales. If you're doing a 3 residential development, most of the mainstream lenders will want probably at least 1 pre-sale, maybe 2. Some of the banks, for example, Westpac are coming out recently saying they want 100% debt cover via pre-sale. So that's not 100% of the total project pre-sold, it's the debt. So just going back to that example, if you've got 1.5 million in total end value, you've got $1 million in debt, so that's an easy number to work out. You'll need 2 pre-sales out of 3. So if you're selling 3 houses for 500,000 each, and you've got debt of $1 million, you'll need 2 pre-sales, and that will get you 100% debt cover via pre-sales. And obviously, the higher you go up, so you've got 4 residential development or 6 residential development, you'll obviously need more, but just work within those ratios. But generally, if you get a good lender who understands you, you've got good servicing income, outside of what the profit the project's going to generate, you could get no pre-sale requirements. So it really just depends on your individual circumstances. So I'm just seeing if there's any other questions here. Otherwise, it looks like we might be finishing very early. Okay. Can you plan for future funding? That's assuming you're capable of doing more than 1 development at a time. So that's from Carly. Yes, you can. And that's sometimes important to have a split banking approach. So where you've got 1 or 2 lenders working on individual projects, that strategy can work. So it's again important. Don't hide from the lenders, what the other project might be and who that's with. The more again you show the lender what you're doing, that will encourage them to potentially try and get the funding for your other developments. So I think going confidently, you can have multiple projects on the go at any one time. So Amanda probably won't mind me saying always a number of projects simultaneously on the go there. So we're constantly, telling a story, building the picture, and just working on options there. So that's important. Okay, so from Andrew Spinks, hello Andrew, how can you improve serviceability, or are there lenders that are better if you are on a lower income, or ways to get around this? So good question. I think Andrew, if you've got a lower income, you're probably, and you're looking for peak debt on a 2 or 3 residential development, you're probably going to sit with the second tier market. The banks will want to see you being able to service any existing debt plus any peak debt on the project, with assuming no pre-sales are going to happen. So where you've got a lower income and you might fall outside of the major banks' lending criteria, you can still end up with a second-tier lender, a credit union perhaps that might be a bit more open to some flexibility there, or even the private lending space. So we're doing, a bit of that stuff on the Keystone side of the business, which is a private lender, but the rates are a lot higher. So you don't want, you just want that for a short-term position. And then that really is the asset lend space. So if you're getting into just the pure asset lend space, you're obviously going to pay a higher interest rate than you would with the majors. So sometimes the higher interest rate can work, because if you're making a 20+% profit on a project, and you've got a funding from a La Trobe or someone, or a Balmain at sort of 7 or 8% on the debt costs, that can still work. You'll obviously impact slightly your project profitability, but as long as you sort of understand the impact that might have, that might be what you're required to sort of get going. And once you get a few projects under your belt, you demonstrate that you're good at what you're doing, then you might fall back into the major bank space. So it certainly is tough in this environment. The banks are very cautious about who they're lending to. They want to see experience. So where you don't have that experience, that's where I think you really do need to emphasise the team you've got behind you, really going hard with the upfront information, and you'll get a good hearing. But don't be disheartened if you can't get into the major bank space. And often, you might get more flexibility outside of that anyway in the second tier space, because generally they might be able to move quicker. You get a bit more flexibility. Yes, you might pay a little premium on rate, but don't be too concerned about the rate, because on the bottom line, I guess project profit, everything comes at a cost. But you can, it's opportunity cost, I guess, at the end of the day. So here might be a question for Amanda. What is contingency for non-sale of property? Is renting out a viable contingency as far as bank is concerned? So look, I'll perhaps answer that one, Stacey. If you do buy a block of land and you can get some existing rental income on it before you get development approval, before you launch into your ultimate construction plan, that will help significantly towards servicing. So a lot of banks shade any rental income. So some will shade it up to sort of 20% and then use that for the servicing. Some will take 100% of the rental income. So yeah, that's good. So if you can get rental income, if you've got a 12-month period to do your feasibility, get your DA, get some rental on it, and try and get that to help with the servicing equation. So we've got a question from Kimberly. What are the pros and cons of utilising a business or SPV structure for the smaller developments versus personal lending? So I think, look, if you're perhaps getting into a first-time development, borrowing in your personal names, if you're putting up an existing property as supporting security, that's great. So often borrowers will probably have to start down that path. But where you start to do multiple projects, and this is really a question for your accountant, it's important probably you start to set up an SPV for each entity. So if you've got, I guess, a two-bank approach, definitely the special purpose vehicle is important, because you're just quarantining that asset in a special purpose vehicle. Whereas if you're providing, I guess, as a co-borrower, or an individual borrower, really the banks might look at that as, we want the whole lot and we won't let you separate out the debt. So it really depends, but it's certainly, there's pros and cons with each, and it depends on your circumstance. So I could talk for a long time about that, but we'll perhaps move on. And happy to answer any questions, if any of you want to just have a no obligations or free chat, post this, please, reach out, and I'll see how we go. Going on holidays on Tuesday, so perhaps it might be the week after next. So look, I think, thank you, Kimberly. How are we going for time? We've got 15 minutes. I think you guys are going to get an early minute here, unless we've got any more questions. So I'm going to ask Amanda. Sorry, this is, are the questions coming from up or down?
Down.
Oh, so I'll keep going like that.
Yeah.
Yep, okay. Catherine, sorry if I missed the beginning. At what point in the development process would I instigate discussions with a broker? That's a good question. So, earlier the better, to be honest. So you can have chats with brokers without a financial commitment. So obviously, brokers don't like time wasting. So, to try and identify a broker that's come recommended, within your network, sit down with he or she and just understand what the parameters are if you're a first time sort of borrower in this space. And that they're a good source of information. So who's doing what, where, how long is it going to take? So really engage early. So it is a specialised field. So the more conversations you can have with people that do this stuff every day, the better outcome you'll get. So if you're going into the bank on your own and you don't completely understand the sector, that can be dangerous. And you find that we've had a few clients come to us that have done that, which is great. And if you're confident of doing that, you still can get a good hearing, but you can also stuff up your time frame. So you can get a long way down the journey with a direct approach, and 60, 90 days, you might get a decline. Then you've got to start again with another lender. That can be very disheartening. So I think just be armed with information effectively is the key message there. So would you consider commercial lending terms for developments? Yes, that's a very good question, KC. So commercial lending, some lenders, if you're over 3 residential development for one project, some lenders will actually treat that as commercial funding and provide commercial facilities. But if you're generally under the 3, it'll be a residential product. But yes, commercial, just depends on the lender really. What sort of strategy from Craig would you use to build a credit score? So look, there are some, they're just not at the top of my mind at the moment in terms of the lenders that can help with this credit score. But just Google credit score repair, and there's a swagger of entities that will help you. It won't cost a lot, but some of them can actually remove defaults, even judgments, if you've cleared them. So they'll correspond with the with whoever has lodged a default on your account, and they can help clear it. But yeah, you can perhaps also work with your brokers there. Some conveyancers are getting into this space, so that's a good question. Know what your credit score is up front. That's going to be very helpful.